According to Bank of America, investors should curb their enthusiasm. Bank of America has looked at some big picture observations that are indicating investors may want to take some chips off the table. For one big observation, it's been noted that companies that beat fourth quarter earnings underperformed in the subsequent days to a level not seen since just before the dot-com bubble burst. What this suggests is that the current stock market has priced in blowout earnings. With record inflows into stocks in the first quarter, the optimism has accelerated. In other words, Bank of America believes that stocks are priced to absolute perfection, and reality will most likely disappoint. So, let's take a look. One reason for their perspective is that Bank of America's contrarian measure of Wall Street's bullishness is flashing a sell signal. This chart here shows the levels of extreme bearishness, which is the lower line, and the extreme bullishness, which is the upper line. Currently, the sell side consensus indicator is 1 point away from the bullish upper line. What this means is that the market is feeling bullish. As a contrarian, this is not good news as it indicates investors are now chasing the market higher. As this chart shows, the sell indicator has not reached this level since 2007, which is just before the great financial crisis. But as you can see, the level of bullishness can last for extended periods. Thus, it's not necessarily a good market timing indicator, but just something to keep in your back pocket. This second chart shows the equity risk premium, which dropped below 400 basis points. Briefly, the term equity risk premium refers to an excess return that investing in the stock market provides over a risk-free rate such as bonds. The excess return compensates investors for taking on the relatively higher risk of equity investing. And you don't really need to know all that. You just need to know this chart here shows the equity risk premium as a contrarian negative signal. As you can see, this is only the third time since the great financial crisis that the equity risk premium dropped below 400 basis points. And according to Bank of America, the two prior instances you see in the red circles were January 2018 and September 2018, after which the S&P 500 posted negative 10% and negative 20% peak to trough declines. So let's now go take a look at our charts. Now this chart you're looking at here is the 10-year monthly chart on the iShares Russell 2000 ETF, and the symbol is IWM. And I've told you before that I'm watching the Russell 2000 because I think the Russell 2000 is ahead of the other major market indices. So what we see in the Russell 2000, we may see in the other indices soon enough. Now, just simply looking at the price chart, to me, we're in the middle of April, but right now it looks like we have a nice topping pattern. Let's go see what the oscillators show. Volume, not going to tell us much, and the MAC actually isn't going to tell us a lot yet either. There's still a pretty wide separation between the fast line and the slow line here, and we're well above that zero line, so there's still a lot of power in the market. But if you come on down here into the histogram, then you can start to see, not only in the price chart, but in at least the histogram, we look like we're having a topping process. Moving down here into the price rate of change, we had a bit of weakness here. You can see that, and then another acceleration. So we're still heading on the upside, but I think time is ticking. And you see that here in the relative strength index, we're at a relatively decent 82.15. Yet you can see that it's turning over. At least it's going sideways. It might not be heading down yet, but it has to go sideways before it heads down. So you can look at these past experiences on the RSI and see that, well, we were up here in late 2017 and once again in mid 2018. But remember, we had a pretty good drawdown at this point here. So although it can stay up, there might be some 5 to 10% pullbacks. So just keep that in your mind. And here into stochastics, much the same thing. We're heading up into that overbought territory here. We can hang here for a while, as you can see back here. But I think time is not necessarily on every investor's side. And here into Williams, much the same. Back on up here to the price chart. And once again, I'm looking at the Russell 2000 because I think it's slightly ahead of the other indices. And so if the Russell starts to break and fall, you can bet that the other indices will do the same. And so for today, that's ChewDog Charts. Thank you.